All right, so once again, good evening to everyone. I hope you're all doing wonderfully well. Welcome to our second collab session where I will be taking you through a couple of questions based on Learning Unit 3. So, this is something I've put together. It is a document that just has some of the main stuff that you'll come across in this learning unit. So, what I would advise is on the top right hand corner, you will see next to the bin icon an arrow pointing down. This enables you to download the document that you see on the screen. So, please, can I ask that you do download this and make use of it to follow? And then I will also be uploading it to VC Learn for you as well. So it will be under the case studies and activities folder. So you can also access it there, but if you'd like to just have it on hand with you now, perhaps you can just download it using that down arrow on the top right hand corner. So as I was saying, we are looking at Learning Unit 3 here. It is a section called Managing Working Capital. And there's a couple of different things that you can have come up here in terms of practical or application-based questions. So one of them is to actually calculate your net working capital, which you'll see is the first two examples we'll be working with. And then you'll also see that we have a debtors schedule in terms of collecting from debtors. I'll explain it to you as we go along. So we look at how to draw up a debtors collection schedule, and then we'll also look at how to draw up a creditors payment schedule. So these are just some of the things that you can find or come across in terms of Learning Unit 3. They're pretty straightforward. And then most of the examples that you see up on the screen are from past papers. So it's either tests that were written in the full-time space, or it is an assignment that was previously done in the distance space, or an exam that was written. So it really is quite useful in that sense because it gives you an indication of what you can typically expect for this learning unit. So let's go ahead and get started. And if you have any questions, you can just let me know along the way. You can type it into the chat, or you can press the raise your hand icon. So the first question is looking at how to calculate net working capital. So here, as you can see, they have given you, and they said to you that the following assets and liabilities relate to Marine Foods Limited for the year ended Feb 2017, and they've given you a whole host of items mixed up. Creditors control, long-term loan, furniture, inventory, and so on. So just a whole host of items just mixed up. And then they said to you at the bottom to calculate three things. The first is your current assets, which is also known as your total working capital. Then to calculate your current liabilities, and then to calculate your net working capital. So your net working capital, which is what we are calculating here, is calculated using the following formula. So it's calculated by subtracting your current liabilities from your current assets. So your net working capital is your current assets less your current liabilities, and it's a measure of, it basically is looking at, does the business have the ability to continue its day-to-day operations? So do they have sufficient funds on hand? Should they need to suddenly purchase inventory or pay off a certain employee's wage or salary, or pay off a utility bill or a short-term loan that comes up, or a creditor that needs to be paid in the short term? So it's looking at, does the company have the ability to pay off its short-term obligations with its current assets, with its short-term assets? Now, what's important here is to make note of exactly that, that we have to use current assets to pay off current liabilities, because the idea is that it is in the short term. Any obligation that comes up in the short term, you should be able to pay off using your short-term cash, or whatever funding is available, or maybe you can sell off inventory to generate cash and pay off those current liabilities. because you don't want to have to look to a non-current asset in order to pay off a short-term liability. The idea here is that you don't want to have to, for example, sell off a vehicle, which is a long-term asset, just to pay off a salary or a wage, or just to pay off a short-term loan. So you want to be able to use current assets to pay off current liabilities. And that's what we're looking at here. Does the company have sufficient current assets to pay off its short-term obligations and continue to operate continuously on a normal basis, on a day-to-day basis? So this is what we're calculating here, and it is broken up into 3 steps, which, as you can see, were the questions as well, to calculate your total assets, your total current assets, your total current liabilities, and then the difference between the two, which is your net working capital. They might give you the question like this, where it is broken up into 3 separate parts at the bottom, or perhaps they just say to you, after giving you all of the items here, calculate the net working capital for 2017. So you would automatically know then that in order to get to that net working capital figure, you would have to first have your current assets and your current liabilities, and then work out the difference between the two to give you your net working capital. So let's go ahead and get started with the first part of it, which is your current assets. So here your current assets are going to be, and I'll highlight them in purple. So here the first item is your inventory. This is a current asset. Then you have your input VAT, your petty cash, your bank savings account, your debtors control, your accrued income, your prepaid expenses, and the fixed deposit that's maturing on the 30th of June 2017. So these items are now your current assets. So that would be the sum of the 170,000, the 66,000, the 1,500, sorry about that, the 11,188, 6,000, 2,800, and 55,000. So you would simply just write that out. You could perhaps say current assets as your heading. You'd naturally write out the full word, and then you'd list out your items. So exactly as if they've been highlighted in the table, you would list them out like that. So you would say inventory, and you would write out the figure maybe here. And then you would list out input VAT as the next item, and that would be 1,500, and then petty cash as your next item, and you'd continue in this manner. Oh, sorry, input VAT was 66,000. I actually forgot to highlight that. That's why I skipped it. So that was 66,000. And then petty cash was 1,500. And then you have your bank savings account. So you would put that in here as well and specify that it is a savings account, because it generally is a mark allocated to also stating the item that would fall under your current assets. And remember, again, this is just looking at the short term. Remember, your current assets are your short term assets. So it's all of the assets that have a lifespan of less than a year. Your current liabilities are all of those liabilities that you owe in the short term. It has a lifespan of less than a year. So all you're doing is identifying those items in the table that has a lifespan of less than 1 year. And then the next item were your debtors, and so on. So I'm not going to write all of them out because I did highlight them. But once you have added up all of those items, so all of the ones highlighted on the screen, this gives you a total working capital or a current assets figure. I'm going to write it at the bottom of 500,300 rands. So this is your current assets. Now I'm going to highlight in another color your current liabilities, which is question 2. So in blue, let's highlight all of the items that are your current liabilities. So I'm just going to erase this so I have some space to write here at the top. So your current liabilities, remember, is everything that you would owe, your short-term obligations that have a lifespan of less than 1 year. So your current liabilities, and I'm just going to write down the heading at the top, so you would also write out your answer like this. Current liabilities, underline, and then you can start listing them out. So let's have a look at what are your current liabilities from the listed items. So the first one would be your creditors control, which is 220,000. Then the next one would be your bank overdraft, which is 67,000. Your credit card, 17,000. Accrued expenses, 32,000. Income received in advance, 26,000, and your output VAT, 48,000. So those items now make up your current liabilities. So I'm just going to write out one or two of them at the top to just give you the general idea. So creditors control, and that's 220,000. Then you have your bank overdraft, and that is 67,000. Then you have your bank overdraft, and that is 67,000. Then you have your bank credit card, and that is 17,000. Accrued expenses, and so on. So you'll also total all of the items that are highlighted in blue here, and those added up. So you'll add on income received in advance and your output VAT as well. Those add up to 410,000 Rand. And then your net working capital right at the end is calculated as your current assets less your current liabilities, which in this case is the 500,300 rands less the 410,000, and that gives you a net working capital of 90,300. All right, so that is your net working capital for the first example. Any questions there before I move on? All right, cool. Let's move on then. So the next one is also an example of your net working capital, but just a little bit of a different example. So this says to you, and what I will advise here is that you get a feel for the template that you see drawn up here at the bottom. This is because, and I'm going to highlight it for you. So this template that you see here, this little block with the separations of effect on current assets, current liabilities, and so on. The reason I say that I would suggest you get a feel for it is because if you get a question like this in your exam, you naturally don't have a template or an answer booklet that has tables drawn up for you. You don't have any formula sheet or any sort of format for anything. So you do need to know how to go about answering these questions. You're obviously not obligated to do it in this way, but it is advisable that you do because it just makes it easier for you to have everything in one place. You're able to answer all of the questions in this one block, and it's also easier for you to be able to identify where your figures come from. So I do advise just getting a feel for this so you know how to go about answering the question. And it's also, as I said, based on your net working capital. So we're looking at essentially calculating what the net working capital will be. So here it says to you that the following transactions were entered into by Poppy Pty Limited during October 2016. They have three different transactions. So we're going to do each one of them individually. So the first one is going to be done in the first block here. Then the second one will be done here. And the third at the bottom here. And then at the end, we'll calculate what your net working capital is. So in order to even get to the net working capital, we have to complete these three transactions. And then once we have that, as you can see, this column was to calculate your current assets. This column was to calculate your current liabilities. So once we have every transaction entered, it's just simply current assets minus your current liabilities, and that will tell you what your net working capital is. So let's get started with the first transaction. So the first transaction says to you that there was the sales of goods on credit. So please remember on credit, and it's a sale of goods on credit, which means that it is the debtor that you are selling to. Whenever it's a sale of goods on credit, then it is the debtor that you're dealing with. It was for 95,000, but this was inclusive of that. So again, please make note of that. This was including that. And also, just to make note, this example was from I think it was 2019. So this is when the VAT rate was still 14%. So for the purpose of this example, we'll just work with the VAT being 14%. Even though it is now 15%, we'll just work with it as 14%. So please do make note of that. So this is then saying to you that Poppy Limited has a standard markup of 45% on cost, meaning they add 45% onto the cost of their items and then sell it at that new higher percentage. And the company uses a perpetual inventory system. So here you need to know and how we go about answering this. And this is why we have this first column, which says effect on. We need to now make note of how would we record this transaction of the sale of the goods on credit, 95,000 Rand, but it's including VAT. So we need to know which accounts are affected by this transaction. We already said that the fact that we sold the goods on credit told us that the debtor would be the first account affected. So debtors or trade receivables. Then we also sold goods. So that would be inventory that is also impacted. And then because it was including that, it would also be output VAT that we account for. So output VAT is on the sale of goods. So output VAT is your item to be included here together with your inventory and your debtors. Now, debtors and inventory are both current assets. So I'm just going to write that within brackets here so that you're aware of which column it will go into. You don't need to write this down for exam purposes or assignment purposes. This is just for your own benefit so that you're able to identify which category it falls into. And then your output VAT is a current liability. So I'm just going to write down current liability within brackets. So now that you know these are the three accounts that are affected by this transaction, we need to look at what the actual respective amounts are and put them into the respective column. So the first one was your debtor. So we had sold goods to the debtor for 95,000 Rand. That would mean that the debtor now owes us 95,000 Rand, and since that is a current asset, that would go into the current assets column, and I'm going to show it as a plus because you do need to indicate whether it was something that was added on to current assets or whether it is subtracted. So this is now increasing your current assets account, so plus 95,000. That's the full amount that was sold to or what the debtor had actually paid. Now for the inventory. The inventory needs to be recorded excluding VAT, so or prior to VAT being included. So here we're going to look at what would the amount of this have been without the VAT. And also, they said to us that they had included a markup of 45%. on cost. So we need to bring it to an excluding VAT basis, and we need to bring it to a cost price basis. So remove the 45% markup. So in order to do this, the first thing you're going to do, and you can do either one first. You can first remove the VAT and then remove the markup, or you can remove the markup and then remove the VAT, whichever you prefer. So here for the inventory figure, and you can show the working out within this if you'd like, if there's enough space. You're going to say that the original amount that was sold to the debtor, or the inventory that was sold, was 95,000 Rand. But this was before the, sorry, this was including the markup, was 95,000 Rand. But this was before the, sorry, this was including the markup. So now to remove the markup, it is multiplied by 100 over 100 plus the markup. So 100 plus the markup of 45 gives you 145. So that'll be over 145. And this is now taking out the markup. Now you're going to take out the VAT. So here, you're further going to multiply this by 100 over 114, which is 100 plus the 14% VAT. So now you're going to say 95,000 was the original amount of the inventory. This was including the markup of 45%, so we multiplied it by 100 over 145 to remove the markup. And then we also needed to remove that, so we multiplied it by 100 over 114. So this now gives us an actual figure for your inventory of minus, and the reason I'm saying minus is because you sold this inventory, so this inventory is no longer in the current assets. So that's 57,471. Okay, so that is, sorry, I'm just going to remove this and put it a little bit lower so that I have some space. Okay, so as I was saying, this is now a decrease. It was minus 57,471 because your inventory has now been sold off, so it's no longer forming part of your current assets. So that's your inventory, and then your output VAT, which is a liability, so it's going to go into this column. This now is calculated by taking the amount of the transaction, which was the 95,000, and since you're working out only the VAT, it's multiplied by 14 out of the 114. Remember, and I wrote this here at the top, that 114 is made up of 100% of the actual amount of the item plus the 14% VAT. So this total 114 is made up of 100% of the value plus 14% of VAT. So if you want to work out the VAT only, then it's 14 over the 114, which we just did here. If you want to work out the amount without the VAT, then it's going to be the 100 over the 114. And that's also what we did here in this previous one, the inventory that we had just worked with. Okay, so back to what I was saying, we now have, sorry, let me just erase wherever there was. Okay, so here, this amount, 95,000 times 14 over 114, tells you that your output VAT has now increased the liability of 11,667 Rand, just saying that you are now, as the business, liable for this VAT of 11,667. So that's your first transaction done and dusted. Let's look at the next one. So the next one says to you that the purchase of goods, and this was now purchased by Poppy Limited. So now instead of selling items, they are now purchasing items. So they purchased goods to the value of 43,000 Rand. This was also including VAT, and the goods were purchased on credit as well. So immediately, if the goods were purchased on credit, the first account to be affected by the transaction is your creditor. So immediately I'm going to write down here that it is your creditor, and then you had purchased inventory or goods, so that would be your second account affected. So inventory is the second account, and because of the fact that VAT was included, it would now be a third account of input VAT. So now let's look at the figures. So in terms of your creditors, actually let's first identify what type of account. So your creditors are a current liability, your inventory is a current asset, and your input VAT is also a current asset. So your creditors is now going to be the full 43,000 Rand, because this is how much you would now owe your creditor. And this is now a liability that is created, so plus 43,000 into the liabilities column. Then you have your inventory. Now, again, with your inventory, it is including that. You need to bring it to an excluding that basis. So excluding that, you're going to say 43,000 is the amount. Excluding that, it's 100 out of the 114. So this is going to be an addition because you now purchased the inventory. So it's increasing your current assets, and it's 37,719. And then your output VAT is going to be calculated by taking the amount of 43,000 and multiplying it by 14 out of the 114, and that is a positive 5,281. So that is now the second transaction complete. And now for the third one, it says it's a settlement of an outstanding account by a debtor. Complete. And now for the third one, it says it's a settlement of an outstanding account by a debtor. So the debtor is now settling their account. So we know that the debtor's account is affected. The amount paid after the debtor took. So I'm just going to write down here, debtor is a first account. The amount paid after the debtor took advantage of the company's 2.5% early settlement discount was 9750. So this means that if the debtor is paying us, the amount is going into the bank. And now we need to know what specific amounts are applicable here. So if the debtor is paying us, that means that the debtor's account is decreasing. So we know it will be a minus in this column. I'm not going to write down the amount yet because we still have to calculate it. And then bank, which is a current asset as well, it's going to increase because the debtor is now paying us, so that money is coming into the bank account of the business. So the actual amount that is coming into the bank account of the business is the 9750 that they mentioned here, because they said that this was the amount that was paid after the debtor took advantage of the discount. So this is the amount that would have come into the bank account. That's 9,750. Now, in terms of the debtor, so what they're saying here is that the debtor actually owed you a higher amount, but we offered them a discount of 2.5% if they paid us early, and so that's how they only ended up paying 9750. But the amount that they initially would have owed us would have obviously been higher because that's before the 2.5% discount. So we need to know what the amount would have been before the discount. So if it is an early settlement discount of 2.5%, all you're saying is that 100, actually, let me write out here. Okay, so they're saying to you it's a 2.5% discount. So you're saying that a certain amount times, instead of paying 100% of the amount, you are now paying 2.5% less. And that would have given you the 9750. So 100 minus 2.5% is telling you that it's 97.5% that was actually paid. So you don't know what the original amount is, but that original amount times 97.5% gave you 9750. So to work out the amount, all you have to do is use your normal mathematical rules and take this over to the other side. Since it was multiplication, it will now become division on the other side. So it'll be the 9750 divided by the 97.5%, which you can also, as a decimal, write down as 0.975. And that would give you the original amount, which is 10,000 Rand. So before offering the discount, the actual amount that was owed to us by the debtor was 10,000 Rand. And your debtor is then decreasing by that amount, whilst what's actually coming into the bank account is 9,750 Rand. So now we're done with all three transactions. All you will need to do now is sum up the values in each column. So for the current assets column, it is going to be plus 95,000, and you can type it in exactly like this into your calculator, plus 95,000 minus 57,471 plus 37,719 plus 5281 minus 10,000 plus 9750. And that gives you a total of your current assets of 80,279. And then your current liabilities are simply the 11,667 and the 43,000. So you'll add those two up, and that gives you 54,667. So your final answer for your net working capital, which is what they had asked you to calculate. Sorry, I actually forgot to show you that. Here it is at the top. They said to you calculate your current assets, your current liabilities, and then your net working capital. So now we can calculate your net working capital. So your net working capital here, just want to erase something so I can have some space to write. Okay, so your net working capital then is just the difference between your current assets, which is 80,279, minus your current liabilities, which is 54,667. So your net working capital then is 25,612. Okay, and that is your net working capital, the second example of it. Okay, any questions there? Okay, so let's move on to the next one, which is your debtors schedule. So your debtors schedule is looking at how long does it take for our debtors to repay us. Remember, when a business sells goods, it's either in cash or it is on credit. If it's in cash, it obviously gets paid for immediately. If it's on credit, then the customer has a certain number of days within which to pay. Naturally, it differs from business to business. But here we're looking at, on average, in a particular month, how much do we actually receive from the debtor? So a typical question will give you all of the information that you see up here, and then they'll ask you to draw up a debtor schedule for a particular period, a couple of months, that type of thing. So here it says to you, suppose the budgeted total sales. And again, remember the idea here is that you're looking at sales because we're concerned with not what's in cash, but rather what was on credit. Whatever was sold on credit, that is our concern, because once it's sold on credit, the customer becomes a debtor. and you're looking at, like we said, how much the debtor pays us in each credit. The customer becomes a debtor, and you're looking at, like we said, how much the debtor pays us in each period. So it's based on the sales. So they said to us, this is the budgeted total sales for ABC Limited for the first 2 months of 2015, and they've given you October, November. This is the budgeted sales, 180,000 and 220,000. Then they said to you, I'm just going to skip this for now and look at the one at the bottom here. It says that the total budgeted sales for August and September, which means it's the 2 years, the 2 months prior to the 2 months listed at the top. So August and September, these were the total sales figures. So you actually have total sales for August, September, October, and November 2015. Then they said to you, and again, let's go back to what was here, the second bullet point. They said to you that debtors are expected to pay their accounts as follows. So 70% is paid in the month following the month of the sale. So that's important. It's the month following the month of the sale, basically next month. And then 28% is paid in the 2 months following the month of the sale. So not next month, the month after that. And then the remaining 2% is written off. Now, whatever is written off, and this is very important, you do not worry about it. You will ignore it. It does not form part of your debtor's schedule. The reason we're ignoring it is because the debtor schedule shows you what is actually received. And remember, if you're writing it off, it's no fund that actually is coming in. So you're not going to include it in your debtor schedule. You'll completely ignore the bad debt, or it's also called your irrecoverable debt. So the moment you see written off a bad debt or irrecoverable, just ignore that one, because you are looking at what was actually received in that particular month or year or whatever period it is. So this is how we're receiving the funds. And then they said to you, and this is also very important, that 20% of your total sales is sold on credit each month. This is what we're concerned with. We are concerned with the 20% because it's basically saying to us that we do not concern ourselves with the entire 180,000, for example, for October. We are only looking at the 20% that is on credit because that is our debtor. So we are not looking at the whole amount. It is only what percentage is on credit. Sometimes you might find that they would say to you, for example, 20%. Okay, let's change the figure and just change this word. This is just an example to show you how else it could be presented to you. They could say to you maybe 40% of your total sales is sold on cash, is sold for cash. So if 40% is in cash, then that would make the remaining automatically, it would make the remaining 60% on credit. So you need to be able to identify that, because that in total then gives you 100% of your sales. So you need to be able to identify that if they're saying a certain percentage is in cash, then automatically the difference between that 40% here, for example, and 100 is 60%, which is on credit. Or sometimes it might automatically just say to you that, like in this question, they already said to you that 20% of your total sales is on credit. So we are only concerned with 20% of the total sales. Okay, so that is all the information provided. And then the question right at the bottom says to construct a debtor's collection schedule for the months of October 2015 to Jan 2016. Now, these months that they've mentioned to you at the bottom here are the ones that when you draw up your debtor's schedule, they are the months that will go across at the top. So basically, you're going to have October, November, December, and Jan. So whichever months they ask you to draw up the schedule for in the question, are the months that go across here at the top. Coming down the first column, the month that you start with is always the very first month's information you have. So, although we do have October and November, they also gave you August and September. So, of all of those months, August is the first month. So, August will be the first one that you start off with here, and then it will go August, September, October, November. So this is how you would draw up the table. Again, you do need to know the format of this. They are not going to provide it to you, so please make note of that. So it is also drawn up for you on the next page, as you can see, exactly as I had shown you just now. October, November, December, and January of 2016. And then in the first column, you start off with the very first month's sales that were given to you. So that's August, then September, October, November. So this is what your table will look like. And I'm going to explain the table in more detail just now, but let's start working with the figures, because this at the bottom here, I'll explain this last. So at the moment, we know what months go into the table across as well as down the first column. Now we need to look at what the next step is. The next step is to calculate only the credit sales, meaning we know that the information they've given to us is total sales. We do not want the total sales here and here. We want only the portion that was on credit, which they said to us was 20% of the total sales. So we're basically going to take this 180 multiplied by 20% for October, for November, that times 20%, and for August and September here as well. So the first one, 220,000 times 20%. You can just type that into your calculators. Will give you 44,000, and you'll write down the 44,000 here under credit sales. It's basically saying to you that in the month of August, the amount of goods that were sold on credit was worth 44,000 rand. Then in the month of September, it was the 200,000 times 20%. So in the month of September, the company had sold 40,000 Rand worth of goods on credit. Then in the month of October, it was 100 Rand worth of goods on credit. Then in the month of October, it was 180,000 times 20%. So in the month of October, the company had sold 36,000 Rand worth of goods on credit. And in the month of November, this is the same as August was. It's 220,000 times your 20%. So again, in the month of November, the company had sold 44,000 Rand worth of goods on credit. So now we know what amount was on credit. Now we can start working with when the figures were actually received. So back to the information that was given to you here. Now we're going to look at for the particular month, and where we're going to start here, and I'm going to take you back to this as well. You're going to start with the month of August. So because this is the first month that's listed out here for you, you're going to look at if the sale took place in August. Did we receive any of the payments from the debtor in October, in November, in December, or January? So we need to look at the schedule, and that will tell us if any of the 44,000 would have been received in October, November, December, Jan. So let's look at it. So if the sale took place in August, 70% is received in the following month. That would be September. 28% is 2 months after the sale took place, which would be October. This 2% is written off, so we don't need to worry about that. And then from September and October, that's written out here, the only one that's in our headings at the top is October. So September was not included in this schedule. So you don't need to worry about the 70%. All you need to worry about is now this 28% received in October. So you're going to look at the August figure, work out 28% of it. So the August figure here is the 44,000. You're going to work out 44,000 times 28% or times 0.28. And that tells you that 12,320 Rand would have been received in October from the sale that took place in August. So even though the sale took place in August, because the customer purchased in August but would only pay later on, they would pay us 12,320 Rand in October. And then there's nothing in November, December, and Jan, so you're done with the month of August. Now we can look at the month of September. So 40,000 Rand worth of goods was purchased on credit in the month of September. We want to know, is any of that 40,000 Rand going to be received in either the months of October, November, December, or Jan? So again, we look to the schedule to tell us whether anything would have been received in those months. So if the new month now is, and I'm just going to erase here, so we know which month we're working with. Okay, so if we're now working with the month of September, so 70% is received in the month after that, so that would be October. 28% is 2 months after that, which is November. So we have both October and November in our table. Here's October, here's November. So we need to look at both the 70% and the 28%. So 40,000 times 70% is received in October. So 40,000 times 0.7, that's 28,000 received in October. The remaining 28% is received in November, so that is times 28%, and that's 11,200. Okay, so now you're done with the month of September as well. So we have now accounted for the September sales. Now we need to look at the next month, which is October. So here, the actual sales for the month of October is, or credit sales for the month of October is 36,000 Rand. We want to know, is any of it received in October, November, December, or Jan? So let's go back to the schedule and look at if anything was received there. So if the sale took place in October, 70% would be 1 month later, which would be November. 28% would be 2 months later, which would be December. So both of those are headings in our table. Here, 8% would be 2 months later, which would be December. So both of those are headings in our table. Here's November, here's December. November is 70%, so you'll take the 36,000 times 70%. For November, for December, it's the 36,000 times 28%. So that's 25,200 in the month of November and 10,080 in the month of December. And then for the last month, November. So we're done with October now. November is the last month. So here for the month of November, as you can see, the credit sale is 44,000. Once again, we're looking at, is any of that 44,000 received in any of the months October, November, December, or Jan? So we need to go back to our schedule and identify that. So in our schedule, you'll see that. So now, sorry, let me just erase again. Okay, so if the sale took place in November, then 70% would be in the month after, which is December. 28% would be the month after that, which is January. So here We have December in the schedule, but we don't have January. So we're not worried about the 28% now. It's only 70% of the November sale that is received in December. So 70% of the 44,000 is received in here. So 30,800. Actually, we do have January here. Why did I say we didn't? Sorry. Okay, we do have January here. So that's a tick there. So we are including the 28%. So times 70% here and times 28% here. So that's 44,000 times 70% for the 30,800, and then 44,000 times 28% gives you 12,320. So now we are done with your credit sales, and sometimes in your typical exam questions, that would be all they ask you for. They only would say to you, calculate your budgeted. Sorry guys, I think I got cut off there. So as I was saying, in some questions, they would only ask you to calculate what would have been received from your debtors. So all you would do then is there wouldn't be this at the bottom here. All you would do is sum up the figures that you have in these blocks. So for the year, for the month October, it would be 12,300 plus 28,000, and you'd put in the total here. Then for the month of November, you'd add up those two and you'll put in the total here. For December, those two, it'll be here, and then just that last one for Jan. However, some other examples also require you to do a little bit more work, where you're also required to calculate the cash sales. So the cash sales, and remember I said to you at the beginning of this, that a certain percentage is sold in cash, a certain percentage is sold on credit. So if they said to you here that 20% is sold on credit, which they did say to you at the bottom here, 20% of your sales is on credit, that would automatically make the remaining 80% your cash sales. So your cash sales is 80% of the total sales. Now you can only do it for the months that you're drawing up the schedule for. So you can only look at cash sales for October, November, December, and Jan. So now we need to look at, do we have total sales for October, for November, for December, and Jan? We do have your total sales for October and November. Here it is here. But we don't know what the total sales is for December and Jan. They didn't give us that, so we cannot calculate it for December and Jan. So automatically in this table, I'm going to now put in a dash for December and Jan, and we're going to indicate that there was no figure to calculate cash sales there. But for October and November, we can calculate it. So we're going to take the total sales for October and November. It was 180,000 and 220,000, and we're going to multiply it by 80%. So here it's going to be, and you can show the working out here if you'd like, 180,000 times 80%, and that is 144,000, and then 220,000 times 80%, and that is 176,000. And now you're going to total your sales by summing up the 12,320, the 28,000, and the 144,000 for October. That is 144,000 for October. That is 184,320. Then for November, it is 11 to 25,200 and the 176,000. So you add up those three. That's 212,400. And then for December, it was only the 10,080 and the 30,800. So that's 40,880. And in Jan, there was only one figure, 12,320. Okay, so that is it for your debtors schedule. Any questions on that? Okay, so I'm going to work with the last one. I know that we are running over time, but very quickly, I'll take you through it because it's quite similar to the one we just worked with. So this is an example of a creditor's schedule. So with a creditor's schedule, the only difference is that instead of working with us as a company selling goods on credit, we are looking at now us as a company purchasing goods on credit. So it's based on purchases that are made instead of sales. So it says to you that the purchases made, but so it says below were the purchases made by Stanley Limited for the period April through to July 2012. Now, here the same idea applies. Like we said with sales, you either had a percentage that is in cash or a percentage that is on credit. And we said if 20% was on credit, automatically 80% would be in cash. The same goes with your purchases. You could also have purchases that are made only in cash and then purchases that are also on credit. So again, they will specifically say to you that this percentage is in cash. And if they tell you this is in cash, then automatically the difference between 100, like we saw here, minus the 80 that is in cash tells us that the 20 is on credit, or they will specifically say to you that this is the percentage on credit. So here they said to you that these were the purchases made by the company for April to July. So they gave you the total purchases for the months, and they said 65% of all of your stock is bought on credit. So we are concerned with working out only the 65% for each one of them, and this is going to help us to draw up the schedule. Then they say to you that the payment terms were as follows. So 50% would be paid in the month following the purchase, which qualifies the company for a 5% discount. We'll look at how to incorporate that. Then 20% is paid 2 months after the purchase, and the remaining 30% is paid 3 months after the purchase. Then they said to you that the previous 3 months purchases were as follows. So you also have for Jan, Feb, and March of 2012, the purchases figure, and they asked you to draw up the schedule for the months of April to July 2012. So you're drawing up a creditor's settlement schedule this time, not a debtor's one, because here you are looking at the purchases that were made, remember, not what is owed to, sorry, not what is owed to us by a customer, but rather what we owe a creditor, a supplier. So if you look at the months at the bottom, so they've said to you, draw this up for the months of April through to July 2012. Now, again, as I said to you, what they ask you for specifically in the question is the month that you're drawing up the schedule for. So if you look at the heading on the next page at the top, you have April, May, June, July. These are the months that they asked you to draw up the schedule for. So April, May, June, July going across, and then coming down, remember I said to you, it's the first month's worth of information that they had given to you. So although they gave you April, May, June, July at the top here, if you looked under the additional information, they also gave you the previous 3 months, Jan, Feb, and March. So technically the first month's information that you have is January. So you have January, February, March, April, May, June, July. And you'll see that in the first column as well. So as you can see here, January, February, March, April, May, June, July. So this is how you know which months to include in your table. Again, remember the question tells you which months go across at the top. And then coming down the first column is going to be all of the months for which you have information or purchases or sales figures for. So here you will do exactly the same thing that I had shown you with the debtors. The first thing you're going to do is calculate what the amount was that was purchased. And I'm just going to highlight here. So the amount that was purchased on credit. So your credit purchases, they said to you, was 65% of the total. So you're going to take all of these figures, 208 for January, 156 for Feb, 187 for March, 176, 160 for May, 144 for June, 176 for July, and all of them you are going to multiply by 65%. So for Jan, 208 times 65%, and I'm going to write down the answers here for you. It is 135 200. Then the Feb figure is 156,000 times 65%, and that is 101,400, and you'll do the same for all. So I'm going to write down the figures for you. You actually don't need the month of July, so I'm going to ignore it for now, and I'll explain to you why at the end. So you have your credit purchases. We're going to now look at how much was received in credit purchases. We're going to now look at how much was received in each month. Remember the explanation, the idea is that although the sale or the purchase in this case took place in January, it's possible that we would only pay our supplier in either April, May, June, or July. So we need to look at what amount would we have paid in any one of those months. So we need our schedule for this, and here's the schedule here. So it says to you 50% is paid in the month following the month of the purchase, and we're starting with Jan. So 50% would be paid the month after, so that's Feb. 20% 2 months after, so that is March. And then 30% 3 months after, which is April. Now, of the months Feb, March, and April, only April is in this table. So Feb and March, you're not going to worry about it. So only the 30% in the month of April is going to be accounted for. So we're going to say that the purchase was 135,200 times 30% is now 40,560 Rand that we'll be paying in the month of April for a purchase that took place in January. Then for February, again, the same thing. We're going to look at if we purchased in February, is there anything that we would only be paying for in any of the months April, May, June, July? So let's look at that. If the purchase took place in February, then 50% would be in March, 20% would be in April, and 30% in May. So now we have 2 months that form part of our schedule, April and May. That's the 20% and the 30% of the February figures. So April and May times 20% in April times 30% in May. So that's 101,400 times 20% for April, that's 20,280. And then 101,400 times 30% for May, which is 30,420. Then you have the month of March. So now we're looking at, again, is there anything that was purchased in March that would be paid for in any of the next couple of months, April, May, June, July. So let's look at that. So if the purchase took place in March, then 1 month later is April, the next month, 2 months later is May, 3 months later is June. So all three of these are part of our schedule, so we're going to look at all of them. The first one is 50% being paid, but it qualifies the company for 5% discount. So basically what it's saying is, for the month of March, we had purchased 121,550. So I'm just going to write that here. It was 121,550. Now it's saying that of the 121,550, 50% of it is going to be paid in April. But because we are paying 50% and it is in the next month, it qualifies us for a discount. We're going to now say that instead of this total amount, we're going to get a 5% discount. So we're only going to pay 100 minus 5, which is 95% of this amount. So you're going to multiply that further by 0.95. Please don't make the mistake of assuming that it's a 50% that's owed and a 5% discount. So 50 minus 5 tells us that we're only paying 45%. That is not true. That is not correct, because you're basically saying that what was actually supposed to be paid in this month is 121,550 times 50%. It would have been 60,775 rand that we would have paid, but we're going to get a 5% discount on this amount. So instead of paying the full 100%, 60,775, we're going to pay 5% less. So we're now going to pay an amount of 57,736. So you first work out the 50%, and then you take out from 100, like I did here, whatever the discount is, and this is the percentage that you further multiply that by. So here for the month of April, it's going to be the 121,550 times your 50% times 95%. So that's going to be 57,736. And then 736. And then for the next 2 months, May and June, it's 20% in May, 30% in June. So 121,550 times 20% is 24,310. And 121,550 times 30% is 36,465. And then for the month of April, it's exactly the same idea that I had shown you just now. If the sale took place in April, or the purchase took place in April, I'm just going to erase so you can see what I mean. Okay, so if the purchase took place in April, then 50% would be 1 month later, which is May. Then 20% would be 2 months later in June, and 30% 3 months later in July. So in the month of April, the amount that was purchased was 114,400. So of this 114,400, the first one, the 50%, you're going to say 114,400 times 50%, and then further to that, you're going to multiply by 95% because of the 5% early discount. So that's going to be 114,400 times 0.5 times 0.95. So that is sorry, I wrote it in the wrong place. It is in May. So it took place in April. It's going to be paid for in May 1st. So that's 54,340. Then in June, so we did May, in June, July, it's the 20 and 30%. So here, 20% and 30%. So 114,400 times 20% is 22,880, and then times 30% is 34,320. And then for the month of May, exact same idea. If the purchase took place in May, then just want to erase so I can write. If the purchase took place in May, then the first 50% is going to be in June, and the next one, so this is June, that's July, that is August, but August is not in our schedule. So you're only going to be able to do June and July. So the purchase in May was 104,000. You'll work out for the first 50% that's paid in June. You'll work out 50% first and then 95%. So 104,000 times 50% times 95% in June. And then times 20%, the 30% is in August, which is not part of our schedule. So that's 49,400, and this is 20,800. Then for June, remember, if the purchase took place in June, this would have been in July. So I'm just going to write that out for you. This would have been in July, this would have been in August, this would have been in September. August and September are not in your schedule, so it's only the figure for July. So here the June purchase was 93,600. So you're going to multiply by 50% first and then by 95%, and that would tell you. So in July, it is 93,600 times 50% times 95, and that is 44,460. Okay, then for the month of July, and the reason I said to you I'm not going to even include that figure here is because if you look at according to the schedule, remember, it is 50% 1 month later. So if the purchase, took place in the month of July, then 1 month later is August, then September, then October. None of these, August, September, October, are in our table at the top. So there is no month that you can account for here, so you cannot put in the figures for July. So you actually don't even need July here. So I'm going to use this last column to just total everything. So for the month of April, you'll add up that figure plus that, and that will give you a figure of 108. Up that figure plus that, and that will give you a figure of 118,576. Then for the month of May, it's that plus that, and that gives you 109,070. Then in the month of June, it's that plus that. And please remember to stick to these formats that you see up here. Please don't change the format of it because any other format is not accepted. So don't do your own format of it or something that you saw previously or remember from doing this prior to this. Please follow the exact format that you see here. Okay, so that is it. Any questions from you guys? Okay, so that's it for today then. Thank you everyone, and I'm sorry for going about over time. Please make sure that you try these questions out. There are other examples in your textbook as well, so please have a look at those. Please download this worksheet, this booklet that I put together, and try it out without looking at the answers. Get a feel for it. And hopefully it should be fine with practice, but please do also practice the examples in your textbook as well. I will let you know when I have uploaded a video for you to go over for the next 2 weeks. Enjoy the rest of your evening, and I will chat to you again soon. Thanks, everyone. Cheers.